Hello, everybody. Who in here has heard of LUSD or Liquity? Oh, cool. I see a few hands. So, Liquity is a fully decentralized borrowing protocol that issues its own native stablecoin, the LUSD, to borrowers. And the LUSD is supposed to be pegged to the US dollar, but lately we have seen some peg issues due to the bear market because the borrowing demand is not able to kind of keep up with the demand for holding and buying the stablecoin, which has led to a situation of having like a slightly overpriced LUSD by a few cents. So Chicken Bonds is now a new product that we designed partially to kind of solve this problem, to have like a layer on top that will make LUSD more stable. So yeah, I will quickly go to the agenda. So first of all, I want to give you an overview of the purpose of this project. I already mentioned it's peg stability, but there are other purposes as well. Then what are Chicken Bonds all about? And how do Chicken Bonds lead to another token, the boosted LUSD in this case? And last but not least, we'll see how this all fits together in a nice flywheel. So let's jump right in. So what is it all good for? So I guess most of you here will know that having sufficient liquidity on DEXs has become a big issue in the whole DeFi space. I mean, there are a few solutions, like you can rent liquidity by paying out regular incentives, but it's pretty unsustainable because those incentives are usually very costly. Another alternative is to buy protocol-owned liquidity by having some form of bonding mechanism that was introduced by Olympus Pro. But the problem with that is that you need to not just buy the liquidity at the price, but you would even need to pay a premium and some substantial fees on top. And then there is also kind of a selling pressure stemming from this whole bonding mechanism. So what we are now trying to do here with Chicken Bonds is a novel way of acquiring protocol-owned liquidity without having the projects to buy the liquidity on the market, but by creating like a nice flywheel through a mechanism that kind of automatically will acquire liquidity over time. And this whole system is triggered or powered by a nice yield amplification mechanism for the end user. We'll see how that works. But first of all, let me just quickly show you like how this all will help us or help Liquidity to stabilize the peg. So assuming that we will be able to acquire a significant amount of LUSD, which then becomes protocol-owned, we can do basically whatever we want with it. Like we created a system which allows basically to shift the LUSD dynamically between two places, Liquidity's own stability pool and the Curve 3 pool with the LUSD. And we do that based on the current price. So whenever the LUSD is trading above peg, we can simply shift LUSD from the stability pool to the Curve pool, which has a downward pressure on the price, and vice versa. If the price is below peg, we can shift liquidity back to Liquidity's stability pool. This is kind of a fully algorithmic thing. It can be kind of triggered by anybody. Like it's a permissionless system. Like everybody who has an interest can trigger this shift between the two places. So now, how do we actually acquire the liquidity, like through this Chicken Bond mechanism? So this is a short overview of Chicken Bonds. Like, what are the key benefits? So basically, Chicken Bonds are principal protected, which means that when people bond their LUSD in this case, they can always chicken out, which means they always have a way of getting back their LUSD before their bond is claimed. Then there is also no maturity date or expiry date, which means that the bonds are kind of perpetual because it allows you as a bondholder to claim your bond whenever you want. There is no fixed date, no schedule, nothing at all. And this whole mechanism works according to a curve which grows over time and approaches like a cap. But we'll see how that works in more detail. So basically, when you bond LUSD, you put it in a deposit account, in a smart contract, of course, and you get a bond NFT in return. Like the bond NFT represents your pending bond, which has been neither chickened in nor chickened out. It's represented by an egg, and if you look at the egg, it will kind of start working. It means it will start accruing an amount of BLUSD. BLUSD is an acronym for boosted LUSD, which is a derivative token based on the LUSD, the underlying. So as I mentioned, you make a deposit in LUSD, let's say 10K. There is a cap which is determined according to a formula which I will skip now. But the thing here is that once you've created your bond, your BLUSD balance or virtual balance will start accruing asymptotically towards this cap. Now, you as a bonder, you have two options. As I mentioned, you can either chicken in or chicken out, hence the name Chicken Bonds. Chickening out is not really interesting from the protocol's perspective or from the user's perspective. It just means that you always have this escape hatch or option to get your principal back. So if you change your mind, if you need the money because there is something that just came up, you can always cancel your bond and get the LUSD back. But the more interesting option here is to chicken in, which basically means that you trade in your LUSD for BLUSD. So if you look at now this claiming mechanism under the hood, it basically means that the LUSD that you deposited becomes protocol owned. Like the protocol acquires your LUSD, which you forego, but in return, you get the current balance of BLUSD tokens. Those BLUSD tokens are minted when you claim your bond. So they haven't been in existence before that. They are really just issued when you claim your bond. And of course, you also have this option. This is really simple. If you change your mind before chickening in, you can opt to chicken out, so you get your LUSD back. There is no lockup period, nothing here. So why would people do that? Like, obviously, the B token or BLUSD token needs to have some inherent value, otherwise, like, people wouldn't use the system. So really the question here is, what makes the BLUSD more valuable than the LUSD, or more interesting to people? To understand this, we need to go a bit into the details how the system manages the funds in three separate buckets. So the first bucket is the bonding or pending bucket, which simply contains the LUSD from the pending bonds that have been neither chickened out nor chickened in. They are just pending. Of course, there are now those NFTs, which correspond to the pending bonds. And then, on the other hand, you have a reserve and a permanent bucket. And both of them can be kind of qualified as protocol owned, even though the permanent bucket is even more protocol owned because it's permanent. This liquidity can never escape the system, whereas the reserve is, we'll see, subject to redemption mechanism. We are only using the reserve, in our case, to stabilize the peg of LUSD. You see below, like the buckets, like on the very bottom line. So on the bonding and the reserve buckets, they are just inside, like physically kept inside Liquity stability pool, whereas the permanent bucket is dynamically movable between the stability pool and the curve pool, which you can see there. Now, I mentioned that this reserve bucket has a very specific purpose because it is kind of directly backing the BLUSD supply through a redemption mechanism. It simply means that any BLUSD holder can at any time redeem BLUSD for a pro rata share, a proportional share of this reserve. So you get your, you basically burn your BLUSD, but you get a proportional share paid out in LUSD. So this means that the BLUSD will already have kind of a price floor, because you can think of it as whenever the BLUSD is trading above LUSD, or sorry, whenever the amount that you get upon redeeming is more than the current market value of the BLUSD, it makes sense to redeem. But what's interesting is that this creates a price floor, which is not only like a static one, but it's rising, because all three buckets are earning yield, either in the stability pool or in the curve pool, but no matter where they are, they're earning yield. And there's even an extra yield if you just look at the reserve. If you just look at the direct backing of the BLUSD, then this reserve will earn a higher yield due to this extra yield generated by the bonding bucket on the one hand and the permanent bucket on the other. And the entire yield is compounded and basically put back into the reserve. So this then results in a rising price floor, because the amount in the reserve will just grow over time. And it will grow faster than what you would expect from a normal kind of mutual fund, because there is this extra yield coming from the left and the right. An important property that we wanted to keep, and we designed the system to make sure that this always holds, is that this price floor can only grow due to the amplified yield, but never drop. So there is no dilution here at all. So how do we achieve this? Like, how can we make sure that the BLUSD cannot really be inflated away or diluted away? So this is done through a split mechanism. So basically, when you chicken in, so whenever you want to chicken in, you get the BLUSD amount paid out to the NFT holder of the egg. At that moment, the system would not just mint and pay out the virtual balance, but it would also move the funds corresponding to your bond from the bonding bucket to the reserve and the permanent bucket. And it will split the funds according to a ratio which basically corresponds to the amount or fraction by which the BLUSD supply is inflated. So whatever the inflation is, no matter when you chicken in, whether you chicken in at the beginning or later, you get more or less, that doesn't matter, because the system will automatically adjust the amounts that go to the reserve and the amount that goes to the permanent bucket. And here it's really important that whatever goes to the reserve is basically the same proportion. Like the reserve, if let's say you mint 10% of the BLUSD supply because you're a whale chicken, then 10% of the reserve, like the reserve will then grow by 10% as well. So it's kind of netted out. So that's why we can guarantee that this price floor will never drop. It can only increase. Now, the last point is how this all fits together. We've seen that there is an amplified yield, thanks to the two other buckets, leading to a rising price floor. Now, people, if the market is kind of rational, should price that rising price floor in, which means that the BLUSD should trade at a premium compared to its direct backing. And this premium makes bonding profitable. At least if you wait long enough to chicken in, at some point you will break even because you start accruing the amount. At some point you break even, then you would wait a bit longer until it becomes profitable, and there is also like an optimal point to chicken in. And this whole system would then make bonding profitable, and through that, people would bond more. And the more people bond, the bigger will the pending bucket grow, and the bigger the pending bucket, the higher the yield amplification, because this yield is kind of funneled back to the reserve. So this closes the whole flywheel cycle. So just to summarize the benefits for the end users, the bonds, they are principal protected. There is no time commitment at all. There's no maturity, no expiry date for the chicken-ins either. You can claim your bond whenever you want. The boosted LUSD token is a very specific token because it has no dilution. It has a rising price floor, which also limits the downside. So when you go to the market and buy the BLUSD, it will it will be volatile compared to the LUSD because this premium will fluctuate over time, but at any point you know what your maximum downside is. Because this price floor is really the lowest value that your token, that the BLUSD can drop to, because below that arbitrage becomes possible. So you have this very nice protection as an investor. And last but not least, this yield amplification should really be priced in, even though we don't really know how this will pan out. It's an experiment. But we know that yeah, users will react in one way or another, and yeah, we'll see how this all pans out. So the benefits for Liquidity as a protocol, I mentioned it, we will be able to acquire protocol on liquidity and then use this liquidity in a smart way to further stabilize the peg. So that's it, but very importantly, Chicken Bonds is going live next Tuesday, so very soon. And right now, as I speak, there is a test version on Goerli testnet, which is sped up, like it's running much faster. So if somebody wants to try it out, feel free. We are happy, and if anybody can give us feedback, that would be awesome. Thank you so much for your attention.